Hey guys, welcome to my channel. This is my friend,
Nicole.
and she's a beginner just like a bunch of people who are viewing this video. And I get a lot of frequently asked questions, so hopefully she asks the questions that you want me to answer, right? So I know that you've dabbled in Robinhood, but is there anything specific that you have to ask me?
Well, I am familiar with shares of stock, but I just need to know what are options.
Okay, so an option, I'll keep it real simple, is your anticipation of the stock's movement. Whether it goes up, you're anticipating it to go up, or you're anticipating it to go down.
Okay, so what's the difference?
Okay, so when you're anticipating it to go up, that's a call option. You're getting a call option. When you're anticipating it to go down, you get a put option.
I see. I kind of get the idea, but do you have like some kind of general explanation that you could give me?
Oh, I can give you an analogy actually. Okay, so say that you are a farmer, right? And I'm an evil investor, right? And I know how corn has been moving in the past, and I know that corn is going to have a spike in price soon, right? So I come to your little farm and I say, hey Nicole, I have a contract for you. I will give you $5 a pound for a pound of corn for the next 6 months. And you're really happy because corn is only $4 a pound. You're making an extra dollar per pound, and corn, people are buying tons of corn, right? So with that being said, in 2 to 3 weeks, corn is now $10 a pound. You kind of feel like I schemed you. Oh, I got my contract for a really low price, knowing it was going to go up, and that's how I made my money. I can sell this contract to someone who anticipates corn to be $15 a pound in the future. I don't care. I'll take my double return from 5 to 10, and I'll run away with that. And I'll go into Apple or something. No pun intended.
I see what you're saying. But what would happen if instead the corn that you're talking about were to drop in value?
If the corn were to drop in value and I had the call, right? Which is anticipating it's going to go up.
Right.
Now, if I had corn at $5 a pound and it dropped from the $4 it was at the moment to $1 a pound, who would buy my contract? No one. My contract is worthless. It's worth $1, as much as a pound of corn is, or maybe even less. No one is going to buy it, is what I'm saying. No one anticipates that. No one's going to buy it, right? So now in a put, say someone was smart enough to know that corn was going to go down to $1 in the future, or the investor knew it was going to go down. So he sold me that contract knowing it's going to go down. He's making money because now I have to pay him $5 a pound for the corn, even though it's $1 a pound now.
The farmer.
The farmer. So now I thought I was evil and I was making money off of you, but now you're making money off of me.
I see. Okay. Well, other than price going up and down, is there any other factors that...
Yeah, for sure. I mean, if I got a call option and the stock moves down fast, that will take 25 to 50% of my contract right away, because that's volatility. And another factor is time, after 6 months or 5 months from me having that contract with you, and corn stayed, $4 to $5 a pound, I'm not making money. And if corn stays at that regular value, my contract isn't going up in value anymore. It's losing value, because who really wants to buy a contract of corn for $5 a pound when they could go buy it for $4 a pound still? Months later, if my anticipation is wrong, I'm obviously going to lose value.
Okay, I see. I guess I got the basics down, but is there anything else I should know before I start trading?
Yeah, I mean, as a beginner, I suggest you start a paper trading account, or focus on, starting a small account and just gradually, making small gains here and there that would exponentially grow your account from a broad perspective. 10% here, 20% here, 50% here. That's what adds up. If you're looking for big money moves and a $500 account, that's clearly not going to happen. That's very, very rare to happen. And we do catch those in my Discord. But yeah, when I first started trading, I lost so much money because I didn't have anyone to teach me. I was kind of learning on my own. So yeah, I did take a lot of losses, but those were all really big lessons that, I applied myself. Discipline, consistency, and controlling your emotions are three important factors when it comes to trading. And after a couple of months of you staring at these charts, you'll start to get a general understanding of how a stock moves. And that is what you want. You want to know when a stock is going to hit a certain price level before being rejected. And when it does, that's when you get into a call option, So you have to apply these things when becoming a trader. And it's all about the consistency. That's all I'm going to tell you. If you're consistent and you're disciplined and you teach yourself when to jump in and jump out, those are the best times to get into a trade and just execute. So with that being said, do you have any more questions?
After I got the basics and the psychology rundown, I think I just want to know how to actually place a trade and all that.
Yeah, definitely. We'll get into that on a screen share. So, see you in the next part.
Robinhood account, brand new, and she does not have options turned on, correct?
No, I don't.
But she wants to know how. So, once you have your account set up and everything, you want to click on account. Right, so over here there's going to be a lot of information that we're going to have to block out. So you go to settings and you click get free options trading, and you're going to be asked a series of questions, which I have to say this, answer truthfully. So now this is the end of your application. So when you review and accept your application, Nicole, just give it a second, you are now allowed to trade options. So congratulations. So now you want to know how to actually trade the option, correct? How to buy and sell the options?
Right.
Okay, so pick a stock that you want to trade an option for.
I guess Lulu.
Okay, cool. So we search up Lulu and we click, right? And there's going to be a button that pops up that says trade Lulu options. You did not have this before you allowed options trading. You only had this section to invest in the actual stock. But now we have the option. So once you go ahead and click option, you're going to get expiration dates, which is step 1 of trading an option. You have to know the expiration date. Do you want it to expire this Friday, next Friday, Friday next month, Friday of next year, etc., right? So say we were going to pick one on October 9th expiration, and you were going to get a call. You'd click call, and you want Lulu to go up to $400 by October 9th. So if it goes up to $400 by October 10th, that does not count. It has to be before. So if it goes up to $400 by next week, you could sell it and ultimately collect your money. You understand?
Understood.
You have any questions?
Well, you also explained put options to me, so can you give me a breakdown of how that works?
For sure. So all you have to do is click the put side. I know that put is green now and call is red, but that's because Lulu is down for the day or for the last trading day that it was open. So if you're looking for a put option, you would ultimately be looking for a price lower than the current share price. So you'd probably be looking at a 340 option, correct? A 340 put option. You just scroll down, you see the $340 put option. It says it's $18.60. Now, each contract that you open already has 100 shares, right? So you have to multiply this number by 100. Ultimately, this will cost you one second. This will cost you if you just to buy one, right? So if I was to buy just one, it would cost you $1,800 because you're buying 100 of them at $18.60 each, right?
All right, true.
So same thing if you were to go for a call option. You're buying three, so say we said 400, correct?
Mm-hmm.
So what you do is you scroll up, up, up until you reach 400, right here, right? And it costs $13.40 per contract, per share in the contract. So you have 100 shares and you can't pick between 50 or 75. It always comes within 100. So if you want to get one, it would be 100. If you want to get two, it would be 200 shares, etc. So say I wanted to get one for $32 each, it would ultimately cost me $3,200.
Understood.
Any other questions? Obviously, by the way, you know, a lot of the options that we're buying don't really cost more than $500. So anywhere between $100 and $500 is what we go for.
Is it only that
For
expensive
beginners.
since Lulu trades for about 300?
Yes. So the higher the trading price, and the more famous the company is, the more the option will be, the more interest, the more open interest, the more people applying to buy this contract, the more worth it will be. But what really weighs the contract's price is the volatility of the stock. So if you're in a call and the stock shoots up, your price of your contract will shoot up exponentially. Really. So do you have any other questions?
I think I understand you're saying that it would just shoot up exponentially because of the 100 multiplier, right?
Exactly. So in an ideal sense, this isn't for every sense, but in an ideal sense, for every penny that the stock goes up, you own 100 shares, meaning your option just went up $1. So if the stock is very volatile, for every dollar move on the stock is $100 move on your option. That's the most ideal thing. Obviously, sometimes every dollar move could be a $3 move on your option. It just depends on which contract you got, which strike price. Is it the $402 strike price? Is it the $367 strike price? It all depends. You know, this one's obviously worth more, and if you were to buy it and the stock was to move up in price, this one would make more money than this one, would make more money than this one, ultimately, you know, so on and so forth.
I see. So I have noticed that the strike prices, the lower the strike price, is it like interrelated? Or I'm sorry, is it correlated between one goes higher, the other one goes lower?
Well, yeah, so this is the 367 and this is the 370. So the further the price you're getting, you know, obviously 370 is further than 367, so it's going to be a little cheaper. Right now, if you're on October 9th expiration and the price of this stock is 370 and not 372.5 or above, then your option would be worthless because who is going to want to buy that?
I see.
Now, I want to explain to you the bid and the ask, right? Also, so the bid is the price that people are asking to buy this option for. So people here are asking to buy this option at $20 per share, meaning $2,000 per contract. But people who are selling it are asking for $24.40 per share. Ultimately, $2,440.
Where does the difference between those two numbers come from?
It's more or less on the average of the price. So the market's price is $2,220. And someone said, I know that this option is worth at least $24.40. So they set a stop limit, a sell limit at that. So whenever the stock was to move up to that price, it would sell to whoever is asking to buy it at that price. Now, the markets is this one. So it's really just in between the bid and the ask.
Oh.
So the people who are asking to buy it are asking on an evil level per se. or the market would be in between the bid and the ask. So if I was to go buy it right now for the market price, it would give it to me for $22.20 for whoever is selling it at market price. Obviously, people are trying to get things for a cheaper price, and some people are trying to sell things for a little more expensive than what they really cost. So yeah, that's about it. Any other questions that someone that's new to options would ask?
Well, I always learned that you should wait until it expires to when you're trading options, and that most people do. Why is it that you guys kind of stop? I've always heard that.
I don't like to wait, and I wouldn't, because I'm not trying to buy the shares at that certain price. I just want to buy this option for $100, and when it hits the price I anticipate, that option would be worth $500. So once I sell it right there, I made $400 profit without having to execute anything or without having to actually wait till the expiration date. I can just take my $400 profit now and walk away, and I don't really care what happens with the stock after. You know, I just want to make my money and move on to the next play, set up my plan, execute my plan, because I planned this price to move up here by this date. Yes, I got a further expiration, but that does not get in the way of my plans. So it's always about planning what you want to do and having the stock prove that it wants to move that direction for you. And when it does, you execute at where you told yourself you'd sell. And if it was to move down, you execute at that small loss.
So, is there a fee for taking it out before expiration?
No fee. But if it was in the money, say you got a $350 call and the stock is above $350 and you don't sell, you will be banned for being a careless trader. Yeah.
Okay, so in the money just means profiting.
Yeah.
Okay.
Anything else?
Not that I could think of.
Okay, cool. So if you guys have any questions or anything, leave a comment down below. Like and subscribe for more videos on how to trade, on what a call really is, in detail, what a put is, how to play a strangle, and a whole lot of other things that come with trading. Thank you, and